hey, if you're looking to buy or sell a business and you're thinking about using SBA for a portion of the purchase price of the business, as well as a seller note or seller financing for a portion of the purchase price, then you've come to the right place, because I'm going to walk you through a bunch of the different possible structures and scenarios for using a seller note in conjunction with an SBA loan, and how that can work. And there's a lot of nuance, and this might seem kind of boring, but I actually think it really matters. The details of how you can structure this actually matter, because if you can come up with the best structure, then you as the buyer, you're most likely to be able to win the deal, to be able to acquire the business. And if you come up with a good structure, you as the seller, you're going to be able to come up with the highest purchase price that you might be able to get. And so understanding the different structures and the nuances there actually matter a lot. And a lot of times the best way to do it, you're just going to have to model it out. And so that's what we're going to do today. I'm going to walk you through some different structures and show you how it works in our acquisition financial model template here that I've got pulled up. But before I dive into all the fun nuances of seller notes, my name's Adam Hoeksema. I'm the co-founder of ProjectionHub. And over the last decade, we've helped over 50,000 entrepreneurs create financial projections for potential lenders and investors, and just internal planning. I also spent a decade as executive director of an SBA lender. And so I'm kind of combining my SBA lending work along with my financial modeling work to talk about seller notes and financial models and cash flow requirements with the SBA and that sort of thing in this video. And so I am going to put a link to this template in the description of the video below, so you can grab this template, follow along, model your own acquisition scenarios, run different scenarios, and kind of follow along with me. While you're down there, make sure to subscribe to our channel. I'm coming out with more content that's useful for people that are looking to buy or sell businesses and use SBA financing, and how the modeling can all work with that. So hopefully to have more content that will be interesting to you in the coming months. So make sure to subscribe. All right, with that, let's go ahead and dive into this. Okay, so I have our At a Glance tab pulled up here. And what I wanted to point out to you is right here in the key ratio section, there is this debt service coverage ratio. Now, this is going to be something that we kind of come back to help us check to make sure that, hey, the structure that we are proposing, and we're going to change around and play with some different structures, we want to make sure that the structure we're proposing will be eligible for an SBA loan. And one of the things that can kind of get us in trouble with not being eligible for an SBA loan would be if the deal does not cash flow. And the way that they will calculate whether it cash flows is if your debt service coverage ratio is 1.25, usually that's the kind of the magic number, 1.25 or higher. And the way to calculate debt service coverage ratio is to take your net operating income and divide it by the principal and interest payments, so your debt service, the principal and interest payments that you'll make in that year. And they want that ratio to be 1.25 or above. Now, in this model, I've got this all filled out with some example data of an example acquisition, and we're projecting the net operating income you can see in this row here. And based on the numbers we're starting out with, you can see, hey, we've got, even in our worst year, the second year, our debt service coverage ratio still is above that 1.25 number. So now I want to kind of talk through some different scenarios. And so if we come to our input assumptions tab, this is where we can set a lot of the different assumptions about the acquisition price and how the financing is going to work. And so you can see up here, we've got this purchase price. So in our example, what we're starting out with is $1 million acquisition for the business, a purchase price of $1 million for the business. And with an SBA loan for an acquisition, you can finance 90% of the deal with an SBA loan. You can finance 5% through a seller's note, and then the other 5% would need to be equity invested into the deal. And so here's how we have this set up right now to start out with. It's kind of that typical 95-5 structure. So we've got a $900,000 SBA loan here, a seller's note of $50,000, and then we're actually investing $100,000 in equity, but $50,000 will be used for the acquisition, and let's say the other $50,000 will be just working capital that we want to have on hand to operate the business. So one of the things you need to know here is that with a seller's note and an SBA loan, you're almost always going to have that seller's note on full standby, which means that the seller note cannot receive payments until the SBA loan is fully paid off. So if you're on full standby, that means we can't even start to receive payments on this $50,000 seller note until July 1st, 2033, because we have a SBA loan that starts July 1st, 2023, and it's got a 10-year term, 120 months. So once that's paid off, then we can start to make payments on the seller's note. So that's going to be pretty common. Now what happens, let's say, I'm going to run through some different examples. So let's say we actually want to see if we can get a $1.1 million purchase price. What are our options here? So if we were to just increase this SBA loan to $1 million, one thing we need to note is we need to make sure that the SBA loan is not covering more than 90% of the deal, and so that's something you'd want to play around with a little bit. But just to give us some rough numbers, if we increase that to $1 million, we come back over here to look at our debt service coverage ratio, and we'd see, ooh, we're projecting to go below that 1.25. So the lender's probably not going to approve this deal. So we can't sell the business for 1.1 based on the assumptions that we have in here now. So what could we do? Well, we could increase the seller's note instead of the SBA loan. So we can change the SBA loan back to $900,000 and instead make the seller note $150,000. And when we do that, when we come back to that at a glance, we're still in good shape. We're still above the 1.25. And why is that? That is because this seller's note really doesn't impact cash flow since you're not making any payments on it until 2033. So it doesn't impact that debt service coverage ratio. Now, you could increase the seller note to a higher percentage of the purchase price, but obviously the seller may not be excited about that. The seller may not want to have that large of a portion of the acquisition price to have to wait on that for 10 years, to be on full standby for 10 years. Probably not too excited about that, right? So what are some other options? Well, you can find a way to convince your lender, perhaps that you are going to increase revenue or decrease expenses, and in such a way that your net operating income will increase enough to be able to meet that debt service coverage ratio at that higher price. So for example, if you said, hey, we're gonna buy a new piece of equipment that's going to allow us to increase our production capacity by 25%, and will also increase our net operating income by 25%. And so based on our projections, we're actually going to have a much better debt service coverage ratio. If you can make a good case for that, the lender may take that into consideration and allow you to kind of move forward in the SBA process. Now, to start with, what they're going to do is they're likely going to take your historical financials. So they're going to look at historical financials and say, okay, let's add in this SBA loan. And based on your net operating income from last year, would you be able to cash flow? Would the business be able to cash flow this loan? And a lot of times the answer might be no, it doesn't. And so that's where you have to start getting creative about, can you convince the lender based on a forecast or projections that you can increase net operating income enough to be where you need to be? Or do you start increasing the seller's note? Do you drop the purchase price? So those are a couple of your options. Or do you raise more investment? So you could also increase the amount of equity that's invested. So maybe the seller says, nope, I'm not doing a $150,000 seller note. I'm sticking with the 50. Not willing to do that. But the bank isn't willing to, because of cash flow purposes, the bank isn't willing to go up to $1 million on the loan side. So then your option is to, you could increase this by 100,000. So you get your equity investment and acquisition up to 200,000, and you can use 150 of it for the acquisition. So we get our purchase price back up to the 1.1, and we can look at our debt service coverage ratio, and yep, we're still in good shape at the 1.28 based on that scenario. Now, there are all sorts of reasons why the SBA or the bank lender might not be willing to finance the full 90% of the deal. And I wrote a blog post about some different scenarios here that I'm just going to pull up. So kind of the standard that we've been talking about is that SBA loan finances 90%, seller note on full standby of 5%, buyer equity injection of 5%. You could also have no seller note, where the buyer just puts in the full 10% equity. Now, sometimes what happens is the business appraises too low. And so if the appraisal comes back too low, the SBA, your lender, is going to say, well, we're not willing to finance 90% of the purchase price because I know that's the purchase price, but it didn't appraise high enough. Now, if you're the buyer and you still want to pay that purchase price because that's what you think you're going to have to pay, you're going to have to figure out how to fill that gap. And so you could go to the seller and say, let's increase the seller note to 10%, to 15%, to whatever it needs to be to fill the gap. Or you can increase your equity injection, right? So either the buyer or seller can put in more to fill that gap. We've already been looking at, what happens if the business doesn't cash flow. So even if it appraised high enough, but the business, based on its historical financials, can't hit a 1.25 debt service coverage ratio, again, you're going to have to do the same thing. Lower the SBA loan, increase the seller note, put it on full standby, or put in more equity. And then I'd say maybe the last scenario here is that, maybe not the last, but the last one I'm going to talk about is the buyer lacks financial strength. So the SBA is saying, well, your personal financial situation is weak, so we're not comfortable financing 90%. We want a little more room for error, so we'll finance 75%. And again, that just means the seller's got to put in more on a seller note, or the buyer needs to invest more equity. And I think what actually ends up happening depends on who's in the driver's seat, whether the buyer or the seller has more leverage in the situation. So when the buyer lacks financial strength, the buyer's probably going to have to put in more equity. If the existing business doesn't cash flow, that's kind of the seller's problem. The seller's trying to get a purchase price higher than what the business has been able to cash flow. So you might be able to convince a seller to do more, to put in more on a seller note. And then if it's lack of collateral, that could be lack of collateral on the seller side, on the business side, but it could also be lack of personal collateral. It could kind of be a personal financial strength issue on the buyer side as well. So, that's a toss-up, right? Now, I just want to talk about one more kind of scenario here, is that you might not be using SBA at all. So if the deal is strong and the bank doesn't need to use SBA, the bank is making a traditional loan, they can have more flexibility about what they're willing to do. They might not require the seller note to be on full standby. And so that means the seller note could have kind of interesting different payment structures. So you may not have to wait that 10 years or 5 years or whatever until the SBA loan is paid off. So I'll show you just some examples of how you could, if the bank is okay with it, you might be able to, start this seller note payment at the same time and have it, let's say we're going to have it match the same terms as the bank. So starts on 7/1/2023, paid off over 120 months. Now, you might also be able to do kind of one-off payments, also known as bullet payments. So we built in a little section over here. If you scroll over to the right in this template, your bank might be willing to say, hey, if you maintain your debt service coverage ratio and you're profitable and your cash flow looks good, we'll let you pay off the seller note faster, perhaps. And so you might actually be able to put in kind of these one-off payments. So let's just say maybe after you complete your taxes every year for the business, so in April, you can do a look back and see how the last year tax return ended up. If it turned out strong, maybe you can make an extra $10,000 payment or whatever it is on the seller note. And so that's how you would enter that in here. And the bank may be willing. You'll need to get the bank's permission, but if you as the buyer, if you're strong personally from a personal financial statement perspective, and the business is strong, the bank might be more aggressive and willing to, give the seller, repayment faster. It's also possible that the bank would just refinance and pay off the seller after a year or 2 years or 3 years or 5 years, but pay them off faster than the normal amortization. And so anyway, you can kind of set up any sort of, you want to pay the seller an extra $1,000 in February, like every other month you pay them an extra $1,000. You can just kind of set all of these custom one-off payments in this in this section. So I wanted to mention that as well, so you can kind of model any kind of creative seller note structure that you want. All right, I think I'm going to stop there, but if you have any questions about how to use this template, we have a separate video that kind of walks through how to fill out and get the base, your base model and base projections all set up. I didn't walk through that here. So that's a separate video we'll link to in the description of the video below. If you have any questions about that, reach out to us at support@projectionhub.com. If you have any questions about how to structure a seller note or an SBA loan and want to talk through that, we're happy to try to help with that as well. And we hope this has been helpful, and leave us a comment if you thought it was helpful, and if you get your deal done, we'd love to know. All right, thanks.